Today we are going to talk about the taxation of a subsidiary in a national and international context. Imagine you are the manager of a corporation and want to physically expand your business. In general, you have two options: you can either set up a subsidiary or a permanent establishment. In this video we are going to look at the implications if you choose to set up a subsidiary. A subsidiary is a separate legal entity over which the parent company exercises control by substantial shareholding. The subsidiary is taxed separately, as an independent legal body from its parent. A subsidiary can be established either in a domestic or foreign country. To finance the subsidiary, the parent can inject equity and debt into a subsidiary. In case of equity financing, the subsidiary can either distribute its profits to the parent company or retain them. In case of debt financing, the parent receives interest payments from the subsidiary. You may wonder how the subsidiary will be taxed. First, let's consider the case of a domestic subsidiary. Since the subsidiary is taxed independently of the parent, according to the worldwide principle, it is subject to an unlimited tax liability. At the same time, the parent entity is also subject to an unlimited tax liability on its worldwide income in its country of residence. If there are intercompany capital flows between the subsidiary and the parent, such as dividends, double taxation may occur. If the profits of the subsidiary are retained, there is only one level of taxation. If a subsidiary is established abroad, it is a direct investment. The foreign subsidiary is subject to unlimited taxation in the foreign country. Simultaneously, the parent company is subject to an unlimited tax liability in its home country. Besides, the source country may levy withholding taxes on intercompany capital flows. Then, the parent company is subject to a limited tax liability on intercompany capital flows which it receives from the subsidiary in the source country. In this case, double taxation may occur due to the simultaneous application of the worldwide and territoriality principle. To eliminate this, the home country of the parent can apply the credit or exemption method, which are explained in separate videos. To summarize, a subsidiary is an independent legal body from the parent entity. Thus, the subsidiary, like its parent, is subject to an unlimited tax liability in its country of residence. Double taxation may occur if there are intercompany capital flows. Besides setting up a subsidiary, you could also choose to set up a permanent establishment. The tax implications of a permanent establishment are discussed in a separate video.